Okay, fam. So let's talk about smart money versus dumb money. With that being said, let's get it. Okay, so I told you guys that this video was coming. This is an extremely important topic to talk about. Most people vastly, even people that have been in the markets for a long time, vastly underestimate just how significant this disparity really is. So we're going to talk about it, and I will go over some why it's important, why the metric itself even exists, and some strategies that you guys can use if you want to take advantage of this in terms of being smart money versus being dumb money. Okay, so let's get into it. Okay, so first of all, let's go over what smart money versus dumb money actually is. Okay, so smart money are the guys that are buying when nobody basically when nobody else is interested. Okay, when you hear things in the markets like you hear people saying like, "Oh, this thing's dead. It's garbage. It's not going anywhere. This is a pile of crap. Why would I buy that shit? All that stuff." And everybody and their brother on X is saying how this or that. I mean, unless it's a rug pull, obviously that's different. That's not necessarily retail being bearish on something. There's a difference between something being not interesting to retail and something actually being a legitimate scam. Understand the difference between the two. But when everybody and their brother is bearish on something and it looks like it's going anywhere, it's not going anywhere, it's not interesting, all that stuff, that's when smart money will come in and get into something like that if it makes sense for them to do so. Okay, if it's cash flow positive, if there's a catalyst or a reason why they think it's going to go up, whatever the case may be. Okay. um, Whereas when everybody and their brother is bullish across social media or across any particular asset class, um, usually you'll see these guys aping into the top, or as the price is already significantly wrapped up, everybody and the brother wants to talk about it. Everybody wants to go buy it. They don't want to wait for a pullback. Usually, when everybody thinks it's like the new shiny new object, new toy that's just going to go to $1 zillion, that's usually when smart money will get out, take their profits because they bought down here, and they'll just dump on everybody's head. So the reason why the two exist is because, um, look, I'll put it to you. I'll put it to you guys simply like this. Okay, the one major difference, well, two major differences that separate smart money from dumb money are this. Okay, the smart money has discipline, the dumb money does not. Okay, most of the time, not all the time, but there is some pretty smart retail traders out there, but most of the time, most of the retail traders are just they're not really that disciplined. Um, and the second thing that separates the two is that they both feel fear. Okay, they both feel fear. They both have emotions. They feel things when they're in the markets, but the difference is smart money does not allow their emotions to control them. Retail does. Okay, when smart money is underwater, or when they're when things didn't exactly go out as planned, they or when things don't exactly go as planned, they what they do is they feel the fear, but then they move towards their next steps anyways. Which is like, how can I rectify this situation, or how can I can I average down to get a cheaper price? Can I cut it for a loss and just use it as tax loss harvesting for next year? Can I just sit back and wait for the price to rip again, because eventually it will? They'll think about things like that. They won't panic sell and freak out because it went down in price and get out for a loss and, oh god, all this crap. They're not freaking out about it, being all emotional, throwing a temper tantrum, because again, they understand these markets and how they operate. They've been doing this for years. The difference between smart money and dumb money is they both feel fear and feel everything else. Smart money feels everything that everybody else is feeling. They just do not allow themselves to be ruled by their emotions. They separate their emotions from their mind, and they operate strictly from their mind. This is a very powerful tool that can be utilized if you learn to master it. Now, I will tell you guys personally, I do not consider myself to be smart money, but I do have the ability to do this. It is an acquired taste. Okay, it takes years to master this. It's not easy. Trust me when I tell you. All right, so we're going to go over some examples of what smart money versus dumb money would do in these situations. So, what's a good example of what smart money versus dumb money would do? I'll just show you guys simply right here, okay? So Bitcoin's a pretty good example. Everybody and their brother has been super bullish on Bitcoin and the Bitcoin ETFs and all that lately. So we'll use this as a prime example. Where would retail money be buying? They would probably buy right here on this big fat green candle. They'd probably buy right here. They'd probably buy right here. I mean, hell, you might even have some people buying up here, right? All the way at the top before the dump. And it's possible to make money up here. I mean, don't get me wrong, dumb money, retail money, they still make money. They just don't make as much money as smart money, and they're not as tactical or strategic about it as smart money is. Okay. So if retail bought here and they managed to sell the top, they'd make a 33% gain. They sold here. Say, for example, they sold right here and then, or bought here and then they sold the top, they'd make an 18% gain. They bought up here. You make about 8% gain. And obviously, if you bought at the very top, I mean, not everybody's going to do this. Very rarely will anybody do this. But if you just so happen to be the guy that bought at the top, I sure hate it for you. Bitcoin is a good long-term hold. That's all I can say about it. You'd be down about 14% right now. Okay, so it's possible for retail to make money, but what would smart money have done? I want you guys to pay attention to this. When we were talking about this bull flag down here, we were not buying it personally, but if we were going to buy Bitcoin, we would have bought in here, okay? Let's just put a line straight through the middle, okay? And let's just say that smart money's average cost, they were buying in this bull flag, but their average cost was about 63,000, okay? So they didn't time the bottom perfectly, they didn't time the top perfectly, they were just kind of buying in that zone, which is within this accumulation zone right here. Well, if they had bought there and sold at, let's just say, even 100,000, they would have made 55%. That's more money than the retail trader made that bought the first green candle. So smart money according to the smart money versus dumb money alone is already well ahead of the game. Okay, if they had sold the top perfectly from 63,000, this is not I don't think this is the all-time high, but I'm just using this as an example. They would have made over 80%. Okay. So another thing to keep in mind here is, besides retail buying into the hype and smart money buying into the kind of boring phase, boring is sexy, like I said before. Usually what dumb money will do is they'll chase the rally, whereas dumb money will buy either an accumulation zone, they'll buy at the EMAs or some kind of indicator that they use. In this case, we're using the EMAs, or maybe some structure level. Okay. So in structure, in this case, would be about 70,000. Anything under 70,000 would have been considered good because we were kind of chopping under that, and then boom, broke out. Okay, so I'm going to go over an actual stock, not just a cryptocurrency, but a stock that we can show you guys. Okay, so I'm going to show you guys some examples of what dumb money would be doing. Okay, dumb money obviously chasing the rally, smart money buying down here, holding, waiting for the price to rip. So there's a few different ways you could do this in terms of smart money, okay? And you may not always be able to get the accumulation zone. These usually happen at the bottoms of moves. Obviously, when we're in a full-blown QE bull market, you may not get an accumulation zone. That's possible, so you may have to use another metric to actually get your buys. In this case, the EMAs or a future accumulation / structure level would be a good area to consider. But, just for current time's sake, we'll use this, okay? So one of the ways that you could do a smart money move is you could buy an accumulation, all right? So again, usually at the bottom of a move or near the bottom of a move when it's going mainly sideways and doing nothing and it's boring, nobody wants to touch it because it's not doing anything in the retail space, right? That's usually when the smart money is looking at this and saying, this is pretty attractive. Let me go ahead and take a look at this and see if it's worth buying or not. I'm not going to go back to the lows down here, but we'll take a look at this area. So 370 to 650, anywhere in there would have been a good buy area. Just going over the time frame in which this thing accumulated, it spent 272 days in that zone. So you would have had like 9 months to buy this, preferably at the lows, obviously, but anywhere in that zone would have been a good price compared to what you're currently seeing. And we did have these. We didn't realize it was going to explode that much, but we're obviously not perfect, but we still made some money, so can't complain. But just to give you an example, if you had bought down in that zone and you had rode it all the way to the top, you would have made 569% on your money. And you would have had 9 months to accumulate, assuming you bought perfectly at the bottom. Okay, so another good example of what smart money may do is they may buy some of these dips on pullbacks into the EMAs, okay? So I'm going to show you guys some examples of pullbacks into the EMAs here where it would have been a good opportunity to buy the EMAs. If I can find the tool I'm looking for here. Okay, so right here would have been a good opportunity. Right here would have been a good opportunity. Even right here would have been a good opportunity. Hell, even right here would have been a good opportunity. Of course, it depends on what you're willing to pay for it, okay? Most smart money is not going to buy when the RSI is overbought like this. Again, this is on the daily time frame. What they will do is they will wait for they'll wait for an accumulation zone or for the RSI to be oversold. Okay, in this case, we're just talking about the EMA, so we'll get to those in a minute. But at any point, if you had bought any of these dips back here, you would have made money. And again, is there a guarantee to make money? No, but if you're a long-term holder, you don't care about this. So from this first dip, you would have made about 310%. From the second dip down to the EMAs, you would have made about 224%. Third dip here, you would have made 186%. And the fourth dip here, you would have made about 83%. Now, if you bought up here and let's just say, for example, any of these dips ended up being kind of a top and it went down instead, kind of like what happened with us in CLSK, what you could just do in that case is you could just average down by buying shares directly off the market, or you could also buy puts if you think the price is going to go down and make money on those puts as kind of a hedge, so to speak, for your long position. Or you could also do cash secured puts, which means you would need to have the money to be able to buy the shares as a way to get paid and buy the dip simultaneously. Okay, those are ways to kind of rectify the situation. So that is in terms of buying the dip on the EMAs. Okay, I will just tell you guys right now, the smart money move that we use for swing trading, and again, this is for swing trading, this could be applied to stocks or cryptocurrencies. What we look for is a golden cross of the 4-hourly blue and yellow EMA. Okay, in this case, that is a 9 and a 21 EMA. The 51 is there to serve as kind of a last resort. So the first time that we got this golden cross here, you guys can see it led to a massive 32% move. Okay, so basically, here's what we would have done. We would have seen the golden cross, said, okay, we're going to get in on this. We're going to set our stop below the previous low. In this case, it would have been below this 458, get in roughly about 480-ish, and then ride it to whatever the swing high is going to be, and then move our stop up, obviously, as the price continues to climb, so that way we're not taking a loss. We can eventually lock in for at least break even, and then just let the price ride, right? Until maybe the price gets dipped back down below the EMAs. In that case, maybe we would have got stopped out, or whatever. I would just keep moving the stop up below the new swing lows every time it creates one. So this next level here, though, this is what I want to point out to you guys. This is why these 4-hour EMAs can be so powerful. This golden cross right here at 550 a share, this one, if we had just been swing trading this, would have been absolutely stupid. Okay, so this one would have led to a massive 357% gain. Again, we could have easily just kept moving our stops up. Once we saw a higher low being formed, which is basically at the lows right here, every single time we could have just said, okay, we're going to move our stop up to here, and then below here, and then below here, and just keep rinsing and repeating until eventually we get stopped out. Okay, that's another way to do it. Okay, so you have buying in the accumulation, you have the retest of the EMAs, you have the 4-hourly golden cross for the EMAs with the 9 and the 21 EMA. So another example I'm going to go over with you guys is actually going to be the oversold signal. So another way to do this to actually get an even better entry is to either wait for the 4-hourly, the daily, or the weekly time frame to get oversold. And what do I mean by oversold? Either at a 30 or below a 30, or even as close to a 30 as possible. So in this, excuse me, in this example on SoundHound, you guys can see back here in April of 2024, SoundHound bottomed out at 350. The RSI was pretty oversold at that point. Okay. It did lead to a local bottom. It had a nice little move after that. And then same thing here in June and July, right about $4, rode up to about $7. Again, you would have to have some cash sitting on the side waiting for this to happen. If you're a little bit more impatient, you don't want to wait as long, maybe you could take a look at the 4-hour time frame. The last time we got an oversold signal here was in October. You guys can see that pretty much led to a low right there, and then it took off like a rocket. Again, if you're looking to accumulate and you're looking for a kind of a longer term position or a bigger profit, this could be a way to stack your shares. You could have bought this oversold signal. You could have bought this oversold signal. You could have bought this oversold signal. You could have bought this one right here. And every single time you would have bought those, you would have added more shares to your bag. And obviously, by now, you would have had like a 6x on your money, right? Pretty insane. For those of you guys that are more patient, more willing to wait for a much longer time frame, like let's say maybe dividend investors, okay? Another good way to use this for a dividend or a growth stock investor would be the daily or the weekly time frame. In this case, obviously the weekly, it would be very, very rare to get an oversold signal on some of these stocks. You can see on NVIDIA, it only happened twice in the last few years. Maybe the daily time frame, for example. We can go over this ad nauseum. I literally can't make this stuff up. Okay, right here, what happened? Local bottom. Another good example right here in April, what happened? Local bottom. This one wasn't perfectly oversold, but you guys kind of get the idea here. Local bottom. We also are getting pretty close to that level again. We're not there perfectly, but ideally you would want this thing to get as close to 30 or lower as humanly possible. Let's take a look at another stock, for example, a growth stock. We'll just take a look at a few of them, okay? On the daily time frame, what do we see on Tesla? Well, this one's pretty straightforward. So you got an oversold signal here back in November 2023. What happened? It went up after that. Another one here in February 2024. This was in a downtrend when this happened, but eventually it did move up. So you had another signal here, another signal here. If you were patient with this, you could have just bought each one of these signals and it would have eventually ripped to the upside. Obviously, you can see that anybody that was buying into that downtrend and at these kind of swing lows here, they've made a fortune. They've made a lot of money. Let's just put it like that. Okay. I'm actually going to pick a completely random, just kind of off the wall stock. Okay. Nothing that we've actually even looked at before. Let's take a look at this one, CRISPR. Okay. Just so you guys know that I'm literally not making this up. All right. So what do we have here? We have an oversold signal kind of in this area right here, right? Again, it's not perfectly at a bottom, but you guys can see the move up here from this level. It came down about another 8%, but then eventually it popped up 23%. Obviously, this thing being in a bull trend matters a great deal. But again, if you're accumulating shares and you're looking to hold this for a longer term profit, you don't necessarily care about that. If you're super long-term bullish on the stock or the cryptocurrency, you're not really caring what the direction is. If you're looking for oversold signals, you only care that it's oversold, okay? So if this is how you would play the strategy, you would only, theoretically, in this case, you would only be buying oversold signals. You would not buy anything else. For this particular stock, even though it is down, you basically would have bought pretty much right kind of in this area. So it's not perfectly sideways, but 37 to about 54. Now, if this stock goes back up to the all-time highs, which I believe at some point it probably will, because most of the stocks will once the Fed starts printing money, guess what? 135% gain potentially on this one. Another example I could take a look at is Opendoor. This is actually one that we swing traded in the past and made money on. So here's another good example. All right, so we get this little Let's see if I can find it. The brush here. Okay, so we got oversold here. Obviously, this was a bullish divergence, right? Lower lows on the price, higher lows on the RSI, so it wasn't perfectly bottomed out. But if you had just bought the oversold signals and held, you would have been good. Obviously, the price skyrocketed pretty fast and pretty hard, right? You would have made money. So again, here and here, again, we have another example of bullish divergence. What happened? The price went up, and then you bought here, and then you bought here, and this is a massive accumulation zone on top of that. So eventually, when this price goes up to $4, $5, $6, whatever, you would make a lot of money. Okay, so let's go over to some dividend paying stocks, for example, that you could potentially also use the same exact thing on. And again, this could apply to anything. Okay, the oversold signal could apply to crypto, it could apply to growth stocks, dividend stocks, you name it. It works all the same no matter what you're looking at, no matter what you're investing to. Okay, Enbridge, for example, here, and I'm aware that Enbridge is a Canadian company. Doesn't matter. It only matters that it is the strategy that you're using here. So here, and here, these 4 examples back here would have been a good time to buy any of these. Let's just say maybe your average price was on, let's say probably about this dip, $33, right? Would have took a while to play out, but you would have been up a massive 32% on your shares, and you would have been collecting dividends the entire time. Let's take a look at another example. You know what? I'm actually going to use another dividend growth stock. We'll take a look at Pepsi. We can literally use any stock for this. It really doesn't matter. Okay. So Pepsi, for example, you got right here. Keep in mind this is on the daily time frame. You can use any time frame you want to. Right here, right here. Let's see, right here and right here. And for this strategy, ideally, you would want to have cash on the side waiting for these opportunities, because if you don't have the dry powder to buy them, you won't be able to do it. That's part of the reason why we sit on cash for such a long period of time. And we almost always have cash on the side in situations like this where we may want to buy some of these cheaper prices. But I'm just literally showing you guys almost every single time it was oversold. I mean, this is obviously a little bit high, but you kind of get the point, right? Okay, so let's just say, for example, you bought these 8 dips down here minus this one, okay? And let's say your average price was right here. Well, going up to the swing high, assuming that the price eventually goes back to the swing high, you'd be up about 18%. And the entire time, you would have been collecting shares, which you can then write covered calls on or cash secured puts for options premiums, and be collecting quarterly dividends with dividend growth on top of that, okay? So this is one way that a dividend investor could take advantage of the smart money strategies that we teach on this channel. All right. So anyways, hope y'all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.